Yeah, go ahead.
So my question is will be, so in industry the
Hmm.
valuations will be doing this on exact way that I will do in this Excel.
So, okay, let us come to one simple thing first. Okay, what is difference between
Mm,
pricing and valuation? Okay, when you uh, when you do it for a single instrument or a single product, okay,
mhm,
it is called as
mm,
pricing.
I see.
Okay, and when you do for positions, okay, when you do for portfolio, and portfolio might have a single trade, okay, but when you calculate the present value of a portfolio, right, that is
Mhm.
called as valuation. Okay,
Valuation. Okay.
so pricing is an algorithm. Okay, so how we are going to do it? Valuation is, if you have, if I give you for example 10 America, so 10 digital call options, right? So 20
Mhm,
put options, and I give you this as a portfolio, and you find out
mhm.
what is its present value using this Excel sheet, right? Then that will be called as valuation. Okay,
Valuation.
so uh, quant developer, okay, that guy will be interest, or he'll take care about pricing. Okay, so
Okay.
for example, let us say a company is going to use this Excel sheet itself for pricing. Okay,
Okay.
then your this Excel becomes the base algorithm. Okay, so for example, what you will do is you will lock all your formula cells, and you will
Mhm,
only keep your input cells as unlocked, and then you will
mhm.
share that with people. Okay,
Yes.
so people will only just change the update the input and get the output and use it.
Yes.
Now, if somebody finds any issue with pricing, right?
Mhm,
If they find that probably it is incorrect or whatever, right?
mhm.
Then they'll get back to you saying, asking you to take a look as to why something is incorrect. Okay. And then you will fix it, and share back the Excel in the locked format again. Okay. Now,
Okay.
Excel is an inconvenient way to do it. So ideally what you will do is there'll be a repository, Git repository, correct? Where you'll be keeping your library of pricers. Okay. And via APIs, you will expose your libraries to the users, right? Who are users? People who want to do the valuation. Okay.
Yes. Yes.
Now, who wants to do valuation? Okay. Either it could be for finding the present value for balance sheet requirements and all of that. Okay. For example, if a bank has taken 1000 positions, okay, and it has to show as end of quarter whether it has gained or lost or whatever, right? So that requires valuation. So apart from bank doing its valuation, bank also needs to get that validated from a third party, from example a consultancy. Okay,
Okay.
so you need to get it validated from a consultancy, and uh, that consultancy also needs to have a pricer of itself. Okay, so that will be done differently. Okay, so your pricer and their pricer will be different. Okay, so they'll be doing the validation and they'll be providing their value, so that you can cross check against yours, so that you are sure that it is correct. Okay,
Mhm. Okay.
so that is valuation part of it. Who else might use your pricer? For example, risk teams. Okay,
This thing.
if
Mhm,
someone wants to calculate value at risk, okay, of their portfolio, okay, so that what they'll do is they'll calculate the VAR of the portfolio.
mhm.
To calculate VAR, you need to be able to calculate PNL, correct? And to calculate
Yes.
PNL, you require PV, okay? And to calculate
PV.
PV, you require a pricer, okay?
Mm.
So your pricer will be used by multiple people in multiple different ways, okay? Now, uh, so for example, to build this pricer, okay, you must have first read a few material, correct? So you will read a material, and you will create a working white paper out of it. Okay.
Okay.
You will say that, this is the research I did. Okay. Firstly, you will say that these are the various kinds of digital options. Okay. And then, these are the inputs which are required. This is the data which is required. And this is my starting point. Okay. And then this is how I developed thing. Okay. And these are the various iterations which I have done. Okay. For example, you know. You have done various iteration in the sense that you tried various number of steps. Okay, so how many steps you should have and all. Okay, and there were some findings, right? So you observed that if you use any less steps than these steps, then it does not work. Okay, so although you will give that flexibility to the model user that you can use this model with a configurable number of steps, correct? But don't use it less than this. Okay, so you will summarize your journey of model development. Okay, that is called as a model development document, MDD.
Documentation. Okay.
Okay, so you have to maintain a full model development document. Okay, so that later when somebody validates your model, okay, so that guy will check as to how the model works and so on and so forth. Okay, so I think Ramakrishna has joined us, right? Yeah, hi Ramakrishna.
I see.
Okay, so Sandeep, maybe you can start, right? So you can start from the beginning, right? So what you did and how you did
Okay.
and everything. Yeah,
Okay.
go ahead. You can open up your Excel.
Okay. So, hi Ramakrishna.
I see.
So in our model, I basically explain my exercise on valuing a binary option using its closed form solutions and validate the results by using binomial and Monte Carlo methods. So first we have to be understand what the actual exotic derivative is, and next is will be what is the binary option, because binary option is a exotic derivative. So exotic derivative is a customized derivative that is basically used by the company or investors when standard plain vanilla options does not meet its requirement. Like in exotic options, there is some differences will be between in their in a standardized options, like there is a large exposures is will be there is a large contract expiry date is will be there. So this kind of differences is between exotic derivative and standard derivative. So the binary options are those they will give the payoff when your options is will land in the money. Otherwise, you will receive nothing. So this is a binary options is meaning. So in exotic options, binary option has generally two options. First one is will be cash or nothing options, where in this both call and put options is there, and second is will be asset or nothing option. In this both call and put option is there. So cash or nothing means when your stock price, underlying price is will be expire above the strike price. So in that situation, you will be receive the fixed amount. You will receive the fixed amount. And asset or nothing means when your underlying stock price is will be expire in the money. So on that you will be receive the stock value at that time the value of a stock. So these are the difference between cash or nothing option and asset or nothing options. So now we have to be started our parameters. These are the basic parameters is given. This is the trade parameters that we have. That informations. The time to maturity is will be 1 year. Risk free rate is 8%. The volatility is 30%. And dividend is 2%. Our stock price is will be 30, and strike price is 29. And this is the cash amount. Like in cash amount that we have to be received if options is land in the money. In cash or nothing option, it is $100. So this is the closed form solutions. This is the methodology to value the cash or nothing option by its closed form solution. These methodologies represent the cash or nothing options closed form solutions. So here in this we have to be describe this. Q is representing the fixed amount that we will get once if options is will be land or expire in the money. And and in we calculate the present value over there. So we have to be multiply this cash amount with the discount factors of exponential of RT and multiply with ND2. So here in this the best part is will be to what is ND2. So ND2 is coming from the Black-Scholes formula. So ND2 is basically representing the probability that your options is being land in the money. So this is the meaning of ND2 basically. So when you apply this methodology, so you will be get the closed form solutions of cash or nothing, call and put options. So these are the, when you see the value has to be comes in from using this formula. The call options value has to be $52.1323, and put options value is will be $40.1793. So here is the methodology where in this.
Sir, can what RT
Hello.
means?
Your voice is very low, Ramkrishna.
Uh, Now is it audible?
Yeah, yeah, better. Go ahead.
Yeah. Could you please tell what RT means? Exponential of
So,
RT.
yeah,
Yeah.
exponentials of a risk-free rate into times t. This steps is basically a
Okay.
discount
So,
factors.
oh,
Discount
RT
factors.
is risk free.
Understand?
Yes, RT R
Yeah,
is risk free
R is
and T is time to maturity, residual time to
time
maturity.
to maturity.
Okay.
Okay. So here we have to be value the cash or nothing call options by its given closed form solution methodology, where B9 is representing the our cash amount which will be get once options is will be expires in the money. So exponentials of RT is will be our risk free rate, and T is will be time to maturity. Now the next part is will be the important. Here we have to be calculating the ND2. So ND2 formulas to calculating the ND2. Here is the formula where in which we have to calculating the probability by normal distributions ln of, this is our stock price, by strike price, plus this B4 is representing the risk free rate, and B6 is will be representing our dividend yield, plus half of B5 is representing our variance volatility. Here we have to be square that, so this will comes in from the variance, and B3 is time to maturity divided by B5 standard deviation into square root of t, less less this is square root standard deviation into square root of t. So this is the formula that we can solve this. They will give me the ND2 numbers.
So Sandeep, maybe you can just Google up the Black-Scholes formula so that
Yeah,
we
one
can
second.
also see. Yeah, because seeing in Excel is little difficult.
Little bit.
Yeah, yeah, this is helpful.
Yeah, this is helpful. So here, hello.
Yeah, yeah, maybe you can just put the screenshot in your Excel also so that people. Yeah,
Okay, I will be put after that. So Ramakrishna, this is the basic calculations of a D1 that we have to be calculating, and the formula of calculating D2 is will be D1 minus standard deviations of root T. So in our formula here, this one representing the ND1. These things is representing the ND1, and we subtracted the standard deviations into square root of t. That value is will be reflecting the ND2. Here you have to be seen in the formula. This is the formula of ND2. Here this is the formula given in D2, but you have to be just apply this in normal disk. That will give you the ND2 normal value, normal distribution value of and D2. Okay.
Okay.
Here this one is representing, and the cumulative distribution value of normal distributions. So these are the value, and now we are talking the same thing is will be applying in a put options. There is only difference is will be there, the sign is will be changed. When you see here is will be the minus and is will be there, because due to put options nature, due to put options basically. Now in asset or nothing options, we are getting the value by using its the closed form solutions. So this is these our call options value for asset or nothing options, and these are the put options value. Here is the closed form solutions formula, where this S is representing the underlying stock price, and exponentials of subtracted QT. This is the Q is representing the dividend yield. Q is representing the dividend yield and times with ND1. So here these are the basic our result. So applying this methodology, that will give me the value of a asset or nothing call options, EQT. So these are the value of a cash or nothing and asset or nothing call and put option by its closed form solutions. Now in the next we have to be validate this result, closed form solutions result, by binomial method and Monte Carlo simulation method. Now we have to be next just valid give the valuations of this trade using binomial methods here. So first we have to be explain you what is the binomial method. So the binomial method is a mathematical model that is generally used, that is widely used in the industry to value the European, American as well as exotic options. So these are the our given same information of trade information. Here these are the binomial options parameters where we have to be requiring the up move state. So one second, I will be give the same binomial. Yeah, this one here you will see this u is representing the your up move, and d is representing the down move, and this p is representing the probability of up move. So here these things we are to be calculating. Up move is will be reflected e standard deviations root t. This one exponentials of b4 is representing volatility and square root of 8. So this 8 is will be representing the our t value, length of period in years, because we are taking as a 50 periods in our binomial tree models, and our time to maturity is will be 1 year. So we will simply just one time to maturity of our trade divided by 50 period, that will give me the value of our length of period. So here you can see we are taking the 50 period binomial tree model. I will be explaining you in further when we are showing the tree. So first we have to be just cover up this binomial option parameters. Now you can see how we are calculating up move, e standard deviation, root t. Here you have to be seeing this one, the standard deviations root t, and d you have to be calculating just simply reverse this one. So you will get the your down factors. Simply you just given it d1, just reverse this, you will get your down move factor. Now now in next we have to be calculating probability of up move. How we are calculating this one? So this methodologies will be given, just exponentials of rt less d is representing the down factors, divided by this u is representing the up factors, and less d factors. So here we get the probability, this one probability of up move, exponentials of ert. This b5 is will be representing this dividend yield. Here we are to be a less in basically less than in our risk period, because this one is represent this one we are taking discount factor over here, because we have to be get the present values, present value of this one, removing the discount dividend yield effect on our price move. So this one E8 is representing the down move factor, and ER this one is ERT less E4, E4 is representing down move and up minus down move. So this will give the probability of up move, and the same, the probability of down move is will be 1 minus probability of up move factors. And this is the discount factor that we will get simply calculating the exponentials of risk free rate into this one. That will give me the discount value. Now we are just draw the tree. Here it looks like, so we have to be the binomial model is one of the important assumptions is will be there, that they assume that the underlying stock prices tends to be increasing by a fixed percentage of probability up and down move. So what is our probability of up in this case? Our probability of up is 1.044433, and down move probability down move factors is will be 0.95. So now we are simulate our tree. This is our underlying stock price. It is $30. The same is will be given in our stock price. This is $30. Now we are to be assimilating by its assumption that fixed percentage of probability of up move factors. Here this is nothing but we have to be multiply this with our up move factors. Up move factor is representing E3. In E3 our value is will be reflecting is this one, up move factors. And the same thing we will be continuous. Here you can see these up move factors we will be multiplied, and it's another assumption is there is a fixed factor to be downward also. So here we have to be representing multiply with down factors, fixed percentage of down factors. So we can do the same exercise by the 50 period. So that will use the tree structures. It looks like this is the tree structures. You can see this one. This is the whole tree structure. Here in this example they will be given the 3 period, but in our case this is the 50 period tree structures. So this 250 is representing the underlying stock price at a 50 period, at a 50 period. And here and now the next most important step is will be to calculating the value of an options, value of an option. So here these are the methodology that I have to I these are the simply, this is nothing but the simply difference between the stock price minus strike price. That will give me the value of an option at a 50 node is will be 221. But I will be in excel, so we will automate this thing so that you will look like the large formula is over there. But it is nothing, it is simply I will be taken this 250 minus 29 is will be the strike price. So that will give me the this much value. So,
So what is the final
yeah.
value?
Hello. Actually, your voice is coming.
Your voice is very low.
What is the final value?
No, no. This is not the final value. Final value we are calculating. This is just the price at 50 node. So now in binomial model, if we are calculating the value, present value of an options, so we will back calculating this, iterating through the process of a back calculations. Now this is the price at a 50 node. Now we are valuing the option using this. We are valuing the options by discounting this. Here in this, what we are do, so these are the formula. Here I one second I will be explain you bit up is there, probability value of options. No, not given. So I will be explain you, this is the formula is will be given, and how we are calculating this. So this is the methodology of this beautiful binomial model. Just one second I will show you. Here this one we are doing, how we are back calculating these things, because we are simply, this is the price at a 50 node. Okay, this is the price at a 50 node, and this is the value of an option at a 50 node price. Okay, and now we are calculate now as per the binomial model. We are valuing the options by its back calculations, by iterating the calculations through back calculations. So how we are doing in a back calculation? So we are doing nothing but the simple process. Here we have to be multiply this e5, this one multi this price is will be multiply e5. E5 is showing nothing but it is a probability of up move factor. This is here, this is e5. This is the probability of up move factor, and this is the probability of down move factors, and this e9 is reflected discount factor. So here now here you will see we have to be multiply this with probability of up move factor, and this price is multiplied with down move factor. This is down move factor. You have to be simply multiply 1 minus up move factor, that will give the down move factor value, and discounted this by you using your discounted functions, that you have to be calculating its value at e9 column. Here you will see your discounted value. So you will do the same exercise again at the back calculating the same things at at zero till the zero starting node. So now at the end, what you see, this is the value of an option at a 50 node. This is the exact value. I mean, this is the actual value by using this formula of a value of an option. How we will get? We will be get this these things multiply probability of move factor for this one e65, and downward probability with e67, and discounted by e9. So that will give me the value of an call options. So this is the call options example. Here in the next we have to be see the cash or nothing options. The process is will be the same. You have to be draw the same price tree by using the same methodology, but the only difference is will be there is, I will be explaining. In cash or nothing options, there is the cash or nothing option is, if your option is will be land in the money, so you will be get the fixed amount, you will be get the fixed cash amount. So in our case, cash amount is will be $100. So this is the our cash amount, that is our given in our trade information, $100. So this is the price at 50, at 50 node 250, and the options is will be expired. This is the far above, because our underlying prices will be 30, so that will give me the $100 fixed payoff. Now you have to be calculating these things. The whole over here, it's a zero is representing, because at 50 note at a downward move factors, your prices will be this much. But this is out of the this is basically this prices will be less than our underlying price, so the option is will be worthless, so that prices will be zero. So you have to be calculating this whole options value by its your tree, and the valuation methodologies will be the same. You will be multiply these things with the probability of up move factors. I will be explaining you 1 second. This one is will be, you have to be double b this this yeah, this is the give the same value. Here the process is will be the bit same. You have to be multiply these things with the probability of up move factors, and this one is probability of down move factors, and sum up and discounted with your discounted factor. That will give me the value of an option at the 14 at a 49th period. This reflected the 49th period, and the same process you have to be get continue at the zero node. So now at the end, this is your the value of an option at a present, reflect this value is reflecting your present value of an option, cash or nothing option, by binomial option model. The process is will be the same. You have to be just back calculating the whole things at the end. This will be your final result. Now now the same thing is will be for your cash or nothing put options. Here in this your this price is will this payoff is will be zero, because due to we have to be a put option, so the payoff occurs when our underlying price is will be less than our strike price. So strike price in our case it will be 29. So here you will see the $100, your $100 is payoff. So now process is will be the same. You're back calculating these things by our same methodology, probability of optimum undiscounted by discount rate, and at the end you will be get the your value of an options, cash or nothing put options by binomial option methodology. So this will your value $39.1457. Now next is will be we have to be explain you asset or nothing call options. The process of describing the price tree, I mean draw the price tree is will be the same. You have to be simply multiply with the underlying price to price up move factors and down move factors through the 50 period. You will get this kind of a price tree, and at the end you will be value your options. So in asset or nothing options, if option is will be expire in the money, so we will get the value of an stroke price. So value of an stroke price, not the difference at that time when options is will be expire in the money. At that time what the actual underlying price is, we will get this price. So in our case asset or nothing call options at 50 node, the price is will be 250.2643. So this is far above our far above our strike price, because our strike price is 29. So our options is will be expire, our options will be being in the money. So at that period our payoff is will be 250 point this much dollar, the same as the stock price. Now this process is will be in below. You have to see that this is a downward factor, so that your price is will be reflecting 5.05 at that time. The payoff is will be zero due to option is worthless. The price is will be less than our strike price, so that the payoff is will be nothing. Now at the end the process will be the same. You simply back calculating the whole things by our probability of up move and downward factor that I have to be explained in bit above options, and then back calculating these things discounted by our discount factors, and iterating through the whole things, you will get the this month you will get the price asset or nothing call options. So this is our the as a price of a asset or nothing call options by binomial options methodology. The process is will be the bit same. The only thing is to be noticed by the payoff. In cash or nothing option we will get the fixed amount, and in this we will get the underlying stock price rate. We will get when option is will be expire in the month. So now same things will be applying in the put option. You will be just draw your tree according the same manners, and at the end here you will see the, because due to this is a put option, so the payoff is will be here is representing the nothing. And in that case the downward factor, the payoff is will be the price is will be 3.596, and the option is will be expire in the money put in the money due to put option in nature. So this is our payoff. So this is our payoff, and the same calculating back calculating the whole things, at the end you will get the price of an options by binomial model. So this is the price of an asset or nothing call options. So now we have to be see the summary, but which value I have to be our methods calculate. This is the value here, call options value. Our call options value cash or nothing is will be $53, put option value $39, asset or nothing $20, and this is $9. That you observe the large difference because of their different nature of your options. In cash or nothing you will be receive the fixed amount, and asset or nothing you will be receive the value of an stock. So that you observe the large differences between there. And this is the plain vanilla call option that we are calculating in this. The process is will be the same for all options. Now in the next we have to be in for a validation these things we are to be provide the all methods result in a summary, so that we you can see that how what is the actual differences will be observed in the value. So also we will see this in later. So this is the options value by binomial options methods. So next we have to be seen the Monte Carlo methods. Here in Monte Carlo simulations is also one of the greatest methods, and this is a very widely used to valuing not on the valuations of an options, but this method is Sorry.
Am I audible?
Yes, yes,
Yeah,
yes.
yeah, audible. Yeah, please tell.
Yeah, small request, sir. Actually, I have my family just arriving now. So I want to be.
Sure, sure. No worries. You
Thank
can
you for
drop
the
off,
session.
Ramakrishna. Yeah.
I was able to understand.
Sure, sure. Yeah.
Thank you.
Yeah. Bye.
Bye.
Meanwhile, you can continue, Sandeep. I think we are still recording this session, so you can continue with the final Monte Carlo. Yeah.
Monte Carlo simulation. So this is the Monte Carlo method. Monte Carlo method is again is the most prominent methods. This is not only used in the valuation stuff, but this method is more widely used in the some market risk measurement calculations of value at risk models. Here in this Monte Carlo simulations, what we are do, we are to be just simulating the underlying stock price, simulating the underlying stock price by 10 thousands of simulations, and we will by using the geometric Brownian motion. Here you will see that the equation, this is our stochastic differentials equations. And when we are to be using, when we are you applying the ITO's lemma into this, so these equations we will get turns to be around this one. So this is our geometric Browning stochastic differential equations for a under a ITO's interpretation. So there is simply spot price exponentials of our U is representing our drift component, less variance square by 2 into T plus standard deviation dw. Standard deviation w is will be the most important part here, because they representing the Wiener process, and Wiener process is basically representing the randomness. They will creating the randomness in our formula. We will see in our module. Here we have to be simulating the price for a 1 year. You are using 10,000 of simulations. Here this our the same trade parameters data is given. This at initiation point, this is our underlying stock price is $30. Now we are applying the geometric Brownian motions in theirs. The same formula is to be applied. This is the J3 is representing the stock price exponentials of B3. B3 is we are assuming the risk-free rate as our drift component. Drift component is basically representing the what is my expectations of growth rate. So we will taking the risk-free rate is my expectations, then less B5 is will be the dividend yield. We will less dividend yield into that, and the same process is with the same as per the formula, less half into variance square into T B2, and plus standard deviations root T plus norms inverse is basically representing the Wiener process. They will creating the randomness in our formula, in our equation. So we are to be simulating by using this formula. We are simulating the multiple path of an underlying stock price till 1 year, for using 10,000 simulations. So this is our path at 1 year of maturity at 252 trading day. We are assuming there is a in 1 year there is a 252 trading days. So this is our price by using geometric Browning Monte Carlo equations. Here we will, now the prices will be simulating. We are to be calculating the value of a options by given Monte Carlo simulations methodology. Here we are simply calculating the payoff. So in vanilla call options, there is a simple, we have to be calculating the payoff. Thus the payoff is to be calculating just subtracting the strike price in our price. If uh, if if our this stock price is will be greater than our strike price, that will give the difference value. Otherwise this will give the zero value, because our in our first case we will see the stock price is will be 15, but our strike price is will be 29. So this is so this will give the zero value, because the options is will be worthless in that case. So the same process will be doing. We will this will give me the value of a vanilla whole options. Now asset or now we are calculating asset or nothing call options. In asset or nothing call options we will get uh, the differences will be there from standard vanilla option is will be if options is will be expire in the money, so we will be receiving the value of an stock. So here we have seen the example. Our prices will be 30, simulated prices will be 31 dollars, and this prices will be greater than our strike price. So this is option is will be in the money, so that we will receiving the price of a underlying stock price. Here the process is will be the same, just drag these things, so we will get the payoff at a each day. So now the put options is will be same payoff. Here the only difference is will be there when options is expire in the money, they will give me the value of an stock at that point due to put options. Here they're simply uh, calculating is will be there, stock price is less than strike price. And cash or nothing option, they this payoff is will be also same, because it is nature that if options is will be expire in the money, we will get the 100, we will receive the fixed amount. So in our first case, the option, the stock prices will be $15, which is less than about our strike price. So this is option is worthless, so we will our payoff is will be nothing, it stands as zero. So now in next case, here you see our prices will be 31 dollars. So this is this option is in the money, so we will receiving the receiving the $100 as the amount, because options is will be land in the money. So the same things it will be doing with the cash put option. So the payoff, so this will give me the payoff at each simulated price of a 10,000 simulation. Now in the next we have to be valuing this by using Monte Carlo simulation. What we are do, we are simply doing calculating the average of this and discounted by a risk free rate, that will give the value of an option. So this will give the value of an options. Here you will see the J representing the JG3 column. Here you 3 column. This is cash or nothing. All this is the payoff. We are simply taking the average of this and just discounted by the risk free rate, that will give me the value of an option. The same thing we will do in our put options and asset or nothing, call and put option also. So this gives the value, this is the options value by using Monte Carlo simulations method. So now now in the next we have to see the summary. Here what is the difference we will be observed during in our closed form solutions and validation, and in our binomial and Monte Carlo simulation. So here we can see, so this is the price difference. This is the validation result is actually this value, cash or nothing, this value is comes in from the closed form solutions. Here we are to be calculating $52 and $40, and asset or nothing value is 19 and $9.44. So this is 19 and $9.4. This is asset or nothing and this is the binomial tree value of cash or nothing option, and this is a binomial tree value of 9.4 as asset or nothing call and put options. The same is Monte Carlo. So here we will see that there is a almost same value is to be observed by closed form solutions and binomial tree and Monte closed form solutions, and validate this result from binomial tree and Monte Carlo simulations method, and the value is almost same. There is a not too much of a price difference or value difference is to be observed, so that we can say that our result is might be the correct, not given the absolutely 100%, but it is in a particular acceptable range. So this is the important, and the important aspect of this, when we are doing this options value using the binomial model. Initially we will take a period is will be 12 period binomial model. Here the best part is will be that when we are using 12 period, so we are observing the significant difference in my value for getting value from a binomial option pricing model and actual closed form solutions. The difference is to be frankly speak about, there is so much of a difference observed. There are 2 to 3 or even sometimes $4 to $5 value difference is to be observed. This is a large error. This is a large error. So this is the interesting part. So if so in the next what we are do, we are simply increasing the period, increasing the period of a binomial tree, so that we will see my result. There is a quite acceptable, there is a very less value difference is to be observed in this. So this is the important lessons when you value the binomial tree model. So it is important that you have to be using the sufficient period, otherwise you will seen you are the significant difference in your values. So these are the basic exercise where we are to be valuing the binary option by its closed form solutions and validate the result using binomial and Monte Carlo simulations methods.
Nice, nice. This
And
is
here,
this is very good
yeah,
presentation,
that's
Sandeep. It
actually, yeah, because I don't know, yeah.
Yeah, it is not easy to explain, okay? You might think that, you yourself have done it, so you have done it many times, okay? But
Uh-huh.
now you understand, right? It is not easy to explain. Sometimes the things get so complicated, so it
So
starts
complicated.
becoming difficult to, so you have to keep track of what you're saying, right? So I think it must have been a
Hmm.
good learning curve for you as well, right?
Yes, yes, yes.
Yeah, so yeah,
Uh,
nice. I'll just stop the recording, right? And then we can continue our
oh,
discussion.
yeah, yeah, please.
Just give
Yes,
me a
yes.
second. Yeah.